There's a saying in the mortgage market, so goes interest rates, so goes the real estate market. And what I can tell you right now about interest rates is,
and where down we go, oh, 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 where down we go, oh, 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 so where down we go.
that's right, way down we go. We just had the Fed meeting. Jerome Powell spoke, and man, rates have reacted. Let's look at this right off the bat. I've been talking about this magical 7% number. We are finally, look at this, 6.4% today. Again, I always put my disclaimer out there. Everyone's rate's different. Some people are paying costs. Some people have different credit. There are all kind of different loan types. But we want to use the same scale to look at rates. And when we dig in here to this chart for 30-year mortgage interest rates, we can see, again, we were at this high back in the end of 2023, shot back up. Look at this dip here. That is wild. That is from 6.8, almost just below 6.5. Now we've given a little bit back today, but there is no question we are way below that 7% line that I've been looking at for a while to see if we could hold beneath that. And I will tell you, we are not only holding beneath that, we are likely to drop. Now you may say, hey, I thought you said the Fed can't cut the mortgage interest rates, and that's true. It is a little bit of play on words because what the Fed cuts or raises is the federal funds rate, which they had a meeting this week and Jerome Powell talked about, and is a very good reminder to look at. So let's look at the Fed funds rate and why this is important. This is a graph of the Fed funds rate as we really went through this massive increase. Look how fast they increased the Fed funds rate. And the red line are interest rates. So obviously they're correlated. But the more important part is they're not exactly the same. So when you look here, right here around, I don't know, end of March, rates were about 4.16%. Fast forward to right about here, which is the, let's call it the beginning of May 2022, the Fed funds rate, I believe this was a quarter raise. So they had raised the Fed funds rate 0.25%. Yet rates went from 4.16 to 5.10. That's important because even though the Fed only raised rates 0.25%, interest rates shot up over 1%, which means that the interest rate market is forward looking. Obviously the bond market is, which affects interest rates. And right away, based on the market outlook and what Jerome Powell was saying and the Fed stance, they knew that rates were going higher. And so they priced in future rate cuts immediately. So what happened this week? The Fed did not change the Fed funds rate at all. In fact, they left it exactly the same, but we got almost a quarter to close to 0.5% decrease in rates. And why is that? Is because based on the way that Jerome Powell set up the rest of the year, the market is now pricing in more rate cuts. And to give you an idea of that, this is the tool that I like to look at that. And you can see right here is the current Fed funds rate of 4.25 to 4.5. I'm sorry, 5.25 to 5.5. And this next meeting, if you look here, this is a 26.5% people believe it will be 0.25% lower. 73.5% people believe it will be 0.5% lower. That means 100% nobody thinking that the Fed will not lower rates at the next meeting. Now, why is that important? Because this is already priced in. So when the Fed lowers rates, which is what's expected, they don't have to, but the market massively predicting that, there could be no change in rates because those rates have already been priced into the market. And then when we fast forward all the way, let's go to the end of the year. Currently, then we're looking at, there are people 44 and 36%. So let's call that, what is that? So it's over 70% of the people thinking that rates are going to be 4.25 to 4.5. Okay, I was doing some editing on the video and I realized it might sound like I'm saying interest rates would be 4.25 to 4.5%. Actually, that's the Fed funds rate. Interest rates are going to be higher than the Fed funds rate for lots of different reasons, like there's normally a spread between the 10-year and the 30-year. But to keep it simple, even if the Fed funds rate is 4.25 to 4.5, interest rates are going to be higher, but that does mean interest rates would be a lot lower. So just didn't want there to be any confusion. All right, with that, back to the video. That is a huge way down from where we're at now. And I've been saying for a long time, and I've been wrong in some of my predictions. I thought rates would be lower than where they are now. But I have said that once they started dropping rates, I think they're going to go further and faster than what people think. Now, that being said, there are a lot of experts saying that it could be a lot slower than what I'm saying. And slow meaning over the next, or I'm saying fast meaning over the next year. Some people think it will take a couple years. Either way, this train is going down. Their rates are going to be dropping. And the biggest thing I look at, and I want to go full circle, is when we look at rates. So today at $400,000, let's say you were getting a 7% rate. That monthly payment is $2,661. If you drop this rate to 5%, that payment goes to $2,147. That's almost $515 lower per month. I can tell you right now, people looking at houses and they're looking at a $3,500 a month payment with escrows, taxes, and insurance, and all of a sudden that's $500 cheaper. That is going to push a lot more people in the market. Also imagine, that's almost $80,000 to $90,000 more in purchase price, meaning for the same payment, you can now buy an $80,000 or $90,000 more expensive house. And that is going to push more buyers in the market. It's really just a question of, if we have been running around 7%, where will they jump in? Obviously at 5, we're getting a ton of people in the market. My number's always been around 6%. If rates get to 6%, you will start seeing more and more people get off the sidelines and starting to jump into the housing market. And look, it's just in time. If you look at median days on market here, this is across the United States, and this is showing that median days on market is really going up. And if we zoom into Florida, they don't have all the markets here, but for instance, Orlando, Kissimmee, so let's call it Orange County, you can see days on market going up to 52 days. And when you look at parts of like Cape Coral and Punta Gorda and some of these places, houses really going up big time on days on market. And that is important in Florida because we've doubled our inventory in about a year, and it's a trend that is slowly, continuing to go up. But if buyers jump in the market, I believe that trend will reverse itself very quickly. Now, will we get a massive decrease in inventory right away? No, but I do think it will start putting it to more of a balanced market. There are definitely places in Florida that it's more of a buyer's market. Here where I'm at in Oviedo, it's more balanced, and if the house is priced right, it's definitely on the seller side. There's still competition. Your local market's going to be different. That's where real estate agents really understand the market and help guide you on, hey, when should you write a disrespectful offer? And hey, when's this going to be competitive? And then last part of this, and we can come full circle. This is from Redfin saying America's renter population is growing 3 times faster than its homeowner population because of the home, because affordability stinks. That's the real answer. And how renter households grew 1.9%. America's renter population is growing as mortgage rates are up 90% from the pandemic, while rents are only up 23%. And they have this pretty interesting chart that shows that if you look at this, I guess I'd call that orange or pink. Let's go with pink. Shows that renters are increasing here and homeowners are going down. And that makes sense, right? If rates are really high, payments are really high, buyers are going to choose to do what is in their best interest, owning a home or renting. And it's strictly payment driven, right? If they can rent for here and buy for here, it's an easy calculation. But if buying's here and renting's here, it's harder to do, even though it does make sense because you can always refinance if rates drop. And I'm not necessarily a big fan of buying a house that you can't afford, trying to, refinance down to a lower payment that you can afford down the road, because you don't know what's going to happen. With that being said, there are a lot of people that are still trying to time the real estate, trying to find that perfect sweet spot to try to figure out when to buy. And the answer is it's probably right now, because there's really, I like to look at trends. We have 10,700 homes on the market. If we get to 30,000 homes on the market, which is where we were at in, 2008, then there's going to be a major market correction. And if we go from 10,700 homes to 3,000 homes on the market or less, like we were for a few years when rates were really low and the market was crazy, well, then we're going to get massive appreciation. It just matters what's the trend. What's the trend? I believe rates are on their way down, going to push more demand into the market. We're not going to get this huge drop in rates super, super quick. So we're going to get a more controlled amount of buyers entering the market, though I do think that will pick up steam. At the same time, this rising inventory will start to stop and will start reversing. Even now, even with 10,700 homes on the market, it's still, if you go out there and look, you're going to find it a competitive market, especially in a lot of areas people want to live. So it's really about the trend. So what would I do with this information? One, if you already own a home and you thought, should I refinance? Reach out to me now, because this is the time to at least be thinking about it. In my opinion, you still want to wait a little bit. You want to have a target, know where it's at. Again, it's going to be very difficult to time the market. And if you're a home buyer, man, talk about perfect timing. A lot of people still on the sidelines, rates starting to fall, and more programs than I've ever seen. We have this Hometown Heroes program, probably going to be available for a few more weeks at $100 million. Right now, there's $35 million left in this Hometown Heroes fund. If you're a real estate agent, you know, you've got a few more weeks to get buyers to get a house under contract and lock in that rate. Great opportunity. If you don't know what Hometown Heroes is, reach out to me. It's a very once in a lifetime. I say once in a lifetime, it's happened a few times, but probably the last time, where you're going to get your down payment and closing costs potentially help paid for by the state of Florida. So that's what the you know, I like to say what Wayne Gretzky says is where the puck is going. Where the puck is going, lower rates, probably inventory leveling off, maybe starting to even fall some, and the market heading to what I hope is a balanced market. I really don't want to see 5% rates. Yeah, it's great for the business. Like I said in last week's video, we don't need gasoline poured on the real estate market, but at the same time, I don't get to pick. Jerome Powell's not calling me. And we'll keep tracking the data as more information becomes available that moves the market. As always, I'm going to cover it right here. Have a great day, great week, and I'll talk to you soon.